Hello, everybody. Thanks for joining us today. We're super happy to have Ryan back, and we've really enjoyed the time we did a podcast. We did a prior Family Office Insights gig with him, and it's a good story. So we're doing it again. So thank you, everybody, for joining, and also for those that are joining that came prior and invited some people that we wouldn't otherwise have got to. So we always appreciate that. So, like I said, good story on multifamily, lots of history with lending people money to do these deals. So he's seen how the sausage is being made. And there's often stuff in there that'll blow up. And so it's good to have somebody that has experience to avoid those as best you can. So thanks, Ryan, for doing this. Really appreciate it.
Of course. Thank you for having me. Round two.
You bet. Love it. So let's start a little bit at the beginning with your origin story because I think it's important for people to hear, and then we'll get into the fund and you're actively raising for presently.
Sure. Thank you. So it started about 16 years ago. I took a job out of college at a direct lender, seller, servicer of agency debt, Fannie Mae, Freddie Mac, FHA. A company called Arbor Realty Trust based out of New York City. I was actually in the Boston office to get going. I moved to New York and then subsequently came back to Boston, which is where I am now. First couple years really cut my teeth in the analytical side, underwriting, screening deals on behalf of a group of sales originators, mortgage bankers that were nationwide. Pretty intense volume, a lot of units. We screened thousands and thousands of deals a year. Screened a lot of deals that we didn't pursue. However, able to get several hundred transactions under your belt in a very consistent time frame really gave me a wealth of knowledge and understanding as to what it takes to operate an asset, how they're underwritten, what financials, profit and loss statements, rent rolls need to look like to actually optimize the result of a financing, whether that's a purchase, a refinance, recap, etc. And so fast forward a couple years later, I didn't want to be an underwriter. I knew that I thought I had a skill set to go out and start communicating and chatting with people to work with and for them to try to originate debt on their behalf. And so that's effectively what I did in 2013. I jumped over to the production side, same company, same product, and I started building a book of business. Fast forward 10, 12 years later, I was still there, ended up being a top five producer for them, closed about $5 billion worth of debt placement across our product lineup. And rates started to catch people off guard back in 22, early 23. And for us particular, we had a large balance sheet, structured REIT, publicly traded. So we were able to go out and execute and offer high leverage, variable rate floating debt. A lot of people took these vehicles back when cap rates are tight, rates were low, to acquire at 85% leverage with fully funded capex and closing costs, et cetera, minimal out-of-pocket equity from the sponsor standpoint.
Yeah.
And so the playbook ensued from that point forward. You know how it turned
And then
out.
COVID happened,
And then
right?
COVID. So, the icing on the cake,
Yeah.
it caught people off guard in many different ways. Their expenses blew out. They ran out of capital quick. The property couldn't service the debt instruments that were in place because rates effectively went from 3 to 9% in a very short time period.
Ouch.
And so it burned a lot of folks. What happened then, I found myself more and more on calls with asset management, avoiding foreclosure, working through workout events, and trying to mitigate losses from both the lending side, my employer, as well as my client book. And so thought to myself that was a bit of a waste of time. I will back up real quick and say that I had been investing with these folks, say the top five or so clients that I had known for 5 or 10 plus years throughout that entire time
The
frame.
people that
So
you were financing,
the
yes.
people that I was financing
Yeah.
in the right markets, operating the right way, doing good things, and ended up building an LP passive income portfolio across about 2,500, 3,000 doors. And so really started cutting my teeth in that 15-year period, both as a lender, an underwriter, a mortgage banker, but also an investor,
Yeah.
and handpicking the best deals, obviously not investing in all of them or every operator, but really doing my diligence, knowing the credit understanding that I had of these individuals, these properties, these markets, and putting my personal capital in a spot that I felt was safe, um, could cash flow and could compound over a period of time. And so fast forward back to, the workout scenario a couple of years ago, I started thinking to myself, I don't want to continue to do this. Nobody knows how long this market cycle downturn is going to last. How can I leverage my network of GP operator access, deal flow, and introduce my marketplace, my network to that type of investing in multifamily specific real estate? And so fast forward, started building the infrastructure out before I left about 2.5 years ago. And I ended up leaving Arbor about 6 months after building the first, I guess, foundation or building blocks of the company or the platform. And I ended up actually raising my first fund while I was still employed at my former employer. And so really good case study and test case to not only start raising and syndicating capital from different types of capital sources. We can get to that in a minute, but starting to deploy that capital into a portfolio of deal flow that I had access to and really flexing that network. And so I started proving the concept out before leaving my former employer. And then fast forward to where we are today, which we'll speak about as well. We're now on our fourth fundraise. We have deployed about 25 million. And we've invested in about 14 properties in the last 15 months since the fourth quarter of 24.
Nice.
And that's where we are. We actively have a couple commitments out the door. We're closing another deal in a week, another deal in early March. And that's the update and the status at this
Great. So
point.
what's the LP group look like profile wise now for you in the funds?
I'd say it covers the gamut. I would say, we have minimums in each fund. Generally, it's 100 grand, and that's a commitment. Very important to delineate capital raising and funding and commitments.
Mhm.
We raise commitments up front. That's it. We draw those commitments down over a period of, say, 6 months as we invest it into a diverse geographic and operator portfolio across the country. So all the capital is not due up front. We draw them down in, say, 20-25% increments across that portfolio. The retail component has been big for us. We've raised retail capital from probably about 85 different individual LPs. We have a couple independent advisors on the platform that have introduced us. It's really one source of capital, but they aggregate from between 5 and 15 individual investors on their side. And we're actively talking to a couple family offices. Obviously, that's one of the reasons I'm on this platform and have been speaking with you for the past month or so, really trying to scale up in that space, given the room that we have to grow and maintain that ceiling that we've talked about, that cap of investment. We have allocation to scale up, 3-4 times of our deployment numbers today. And so I am a realist in that capital isn't going to come from the retail LP. We need to scale up to 7-8 figure commitments. And so part of what we're doing now is obviously introducing our platform to the marketplace, constantly rolling out new funds and new opportunities that cater to both ends of that investor profile, the individual LP and the institution. And so we have various strategies in place. We have our retail LP funds. We also have our JV co-GP funds that are tailored more towards that institutional single source capital provider that has a bit more expectation on control, various rights and remedies that they require to invest in certain deals, economic outputs that might be different than the expectation of the retail LP. So really what we're doing is creating different verticals, listening to the marketplace, and offering an access point or a conduit for different types of check, different types of equity, because we know that we can deploy them in similar fashion and maintain the deal flow that we have, which is again predictable in a very similar profile, regardless of the investor.
So let's get into the weeds a little bit about that structure, the non-retail structure, because I think it's important for everybody to understand. And this is not your private equity 10-year lockup. This is drawdown with a coupon and then a catch up and that sort of thing. So let's talk a little bit about how that structure works. And that you're not in this, you're not necessarily stuck in this for, 8 to 10 years.
Sure, it's a good point.
And it's a
And I
the cash flow is also something that you're, you unlike a lot of other funds that aren't passing all that through the way you are. And you didn't pay me to say that. I'm just saying I happen to know a little bit more because we've talked about this, but I think it's an important thing to focus on if that's okay with you.
Yeah, the goodies,
Yeah, the goodies.
as you've referred to it in the past.
I like the goodies. Yeah.
So, it's important to note that simply because we don't have open-ended funds. We close our funds the day we start deploying. And example of that is we're actively raising for the fourth fund right now. The first investment that we are putting in that vehicle got extended due to seller delays. And so we were able to kick out that fund closing, allowing us an extra 30 days or so to raise commitments and give people time, to continue to learn and educate themselves about us. So it's a closed-ended fund. I think given the stress and the dislocation that we're seeing in the marketplace right now, there's a lot of opportunity that is off market that has a really reasonable basis coming in, given the stress and the dislocation of not only the current ownership, but the current financial instrument, the current debt. They're very undercapitalized. They are being mismanaged or misoperated in various different forms. But what that's offered my marketplace is a condensed hold period where we're able to get into these deals at such a discount today, call it 20 in some cases 35% discounted to prior trade pricing or current market comps in the area, where we can execute a business plan and our partners can execute on site from a reposition, a value add, a stabilization method in a condensed 3 to 5 year hold period. And so what we do, which is also a bit of a unique strategy, is we look at each individual deal as an opportunistic situation. Given that we're investing in different markets with different operators, we can't possibly predict an outcome that can coincide with the next guy or the next deal. So, whereby we're raising a fund that we deploy into a portfolio, each individual deal within that portfolio is looked at on its own. And so, for example, this deal that we have coming up closing in early March, which will be the first deal in Fund 4, we have roughly a 30 to 36 month hold period on that deal. That's it. We're getting short-term debt in place, buying a rate cap. We're not going back to the floating days.
Mhm.
But the program there is a simple management play. We're not assuming any rent growth. We're not assuming any cap rate compression. The property's been such poorly managed in the last 6 to 12 to 18 months that there's really a lot of low-hanging fruit, I like to call it, by marking rents to market, minimal capex. It's a 1998 build, so it's a relatively new asset, and it's got some scale at 240 units. So you can really get in there quickly and create some economies and efficiencies that allow you to execute in a condensed time period. That's an example where we can acquire, execute, and release or opportunistically sell in a 3 year window. Another deal, for instance, that we're getting
Well,
in, we
before you
might
go
acquire.
on, I think it would be really helpful if you don't mind, Ryan, is that deal came about because of what you said at the beginning. Like there were probably a lot of people chasing that deal, but you found out about it and were able to lock it up. So,
That's all of our deals, right? So
yeah.
we, in the last 12 or 14 months, we've invested with 8 different GPs across the country. I would say 5 of those 8 I've known from my prior life. three or four are new opportunities, new relationships with us because the marketplace is hearing how we invest.
Yeah.
We invest frictionless, but that partnership then enables us to get into their deal flow in their region. 80% of transactions that are happening in the marketplace right now, off market, right? You don't hear about them. They're not being listed by the big brokerage houses that we've referred to in the past, or they're a pocket list, or we're buying from a bank or a lender.
Yeah.
Your common place investor or fund manager or institution does not have this type of access. This access has been built over a decade
Yeah.
and it's expanding given our frictionless nature of how we participate on the equity side in these deals. So that is a good point. The sourcing ability allows us, supports the pipeline that we're able to invest quickly with. And I think, moreover, to that point, we're not just relying on one or two or three sources. We've expanded that bench. Now it's, as I mentioned, 8 different operators, all focused in a bit of a different geography. I would say we love the Mid-Atlantic down to Florida. However, we're now in Indiana. We're now in Houston, Texas. We closed a small deal in Minville, Oregon in December. So we're finding regionally focused operators that self-manage and are vertically integrated, that operate our day to day, and we invest alongside them. And the scale that we offer, right, I guess is another good point to that. We're commanding preference on terms, right? Um, a question I get asked a lot is why would we invest with you as opposed to going and investing into the deal directly as an LP?
Yeah.
My answer is twofold. One, good luck finding that deal. Obviously, you can hear about it by being in my ecosystem and my network. However, chances are you're not going to provide the scale that Seaport Equity brings to that deal through one or multiple of our funds, right? We are seven-figure investors in every deal that we do. And so when you're talking about 10 to 30 to 50% of the equity required to close these deals, we command promotes, we command profit sharing. And so that can come in the form of a preferred equity. We can get to the return profile in a second, but that I'll keep it macro for now. That'll come in a preferred equity return. That'll come in a GP profit share where we are actually taking upwards in some cases of 20% of the GP promotes, funneling directly into our funds, directly into our investors when the deal
Yeah.
exits and there's a liquidity event. You're not getting those goodies as an LP going directly into the deal.
Yeah.
We're only being treated that way because of the scale that we bring. So a couple differentiators there that
Scale that you
people need
bring
to
and
think about.
also the relationship that you have. And, even if somebody comes in with a check your size, they don't have the relationship or the chops to necessarily negotiate the same uh, terms.
That's fair. I left out the fact that we handle debt placement on almost 80% of our deals too, given my background, right?
Yeah.
So the value that I create to the GP is twofold. One, it's equity, which everybody could use more of.
Right.
Two, it's debt. I understand it's a commodity and you can shop that around.
Yeah.
However, we execute optimally through my former employer. I'm involved in the underwriting, the credit side. I have loan committee on speed dial if I need to. So there's different ways that we insert value above and beyond even somebody who's providing a larger check. Now we've invested in 2 deals in the past year where we have invested alongside a JV that we were not a part of. And so those JVs come in, they try to throw their weight around and make all sorts of demands. However, their economics stop at a certain point. Generally, they want to be paid like a pref partner. They want 14% and then they're out. That can be kind of a current pay and an accrue type concept.
Yeah.
However, the upside, we're still involved after that, correct? So they're out of the deal, and then we start sweeping and accelerating promotes for ourselves from that point forward. So we don't the goal is to be the largest investor in every deal or the top two or three. We are not quite there yet. I would say we are top 3 to 4. Our average commitment to date has been about 1 to 6 million bucks per deal. And when you're talking about acquiring 150 to 250 unit assets, the total capitalization, debt and equity, averages 20 to 50 million. Okay. We're getting financing or assuming debt at say 60 to 70% of that total capitalization. And so the equity required to close that deal is roughly between
40 to
six,
30. Yeah. Mhm.
yeah, 6 and 15 million, give or
Yeah.
take. And so Seaport is coming in for a part of that, not all of it, but our ceiling is still ahead of us in that we have room to grow and not get too big because I want to stay in our mid-market, upper middle market deal size space. And I don't want to compete with the institution.
Yeah,
We've
the
talked,
space that nobody's paying attention to or can't be bothered with on some level, aside from not having access to. Even if they had access to it, they wouldn't necessarily play in that arena,
there's
right?
there's less eyeballs on the space, but there's also more opportunity because that's the deal size that everybody got burned by 4, 5, and 6 years ago. Because doing those deals became somewhat reasonable.
Yeah,
You can go out and raise 5 or 10, 15 million bucks.
yeah,
You could bring in an operator as a GP. You could have somebody put up their balance sheet to get a loan, and you could hire a third party management company to run the day to day.
yeah.
All of those variables don't work. There's nobody speaks with one another. Generally, you're non-local to the situation physically. And so problems happen pretty quickly. And when you're talking about running a 200 unit apartment community, there's a lot of things that can go wrong, whereby if you're not paying attention day in, day out, week in, week out, before you know it, your property slides from 95 to 90 to 85% occupancy, your expenses blowed out, and then you're running the risk of not being able to service your debt.
Right.
And so you really need good operators that know what they're doing. Generally speaking, all of our operators, I think I can attest, have cycled 5 or 10 plus deals. They currently own and operate a couple thousand units in their marketplace. Some guys are regional, some guys are state specific. We have groups in Spartanburg, South Carolina that is only in GSP, Greenville, Spartanburg. We have guys in Indiana that's only in Indianapolis and Greenwood and surrounding towns, MSAs. So these guys are intimate with their backyard and they're able to create so many more efficient expense ratios, share contracts, share labor, create economies that non-local operators just aren't able to do because they need third-party oversight, which generally in our business gets very expensive. So that's why we're investing with the guys that we are and making sure that our pipeline just remains predictable. We can keep feeding it. We can stay active. Sometimes if we're not in fundraise mode, I might scale back our commitment on a deal. Maybe we're doing 500 to 1.5 or 2 million on the top end, but we're staying active in the marketplace because people want to know you have a finger on the pulse of what's going on with where you're investing. And that's one of our, I guess, our pillars to success and will continue to be going forward.
And having that alignment where you're investing side by side with somebody who's not only got equity in the deal, but also operating for efficiencies because they're going to prosper as a result, as opposed to handing it to somebody that is going to get paid no matter what the outcome is on the property.
It's a fair point. I have been the largest investor in every fund we've done so far. And I can probably look a lot of people in the face and say that that's not really market. There's not a lot of fund managers out there that can say that.
Yeah.
And so to your point, from an alignment perspective, I'm putting my money where my mouth is first, and I'm driving the bus, right?
Yeah.
So, again, it comes with my experience. It comes with the fact that, I've personally cycled through 6 or 8 deals, currently in probably 4,000 units myself. I've been in bad investments. I've been in mediocre investments, and we've hit home runs, right? So it's a bit of a different ball game when you're starting to manage other people's capital. But I think first and foremost, having us really be the steward of that opportunity for people by investing alongside them as an LP um, does a couple things. Obviously, we're able to spread profit share as a result. I don't need to charge a 2.5% management fee and sweep all the GP promotes that I get at the deal level from the operator because I know I'm profiting as an LP in the fund and the deal itself anyways. So we're able to cut those way back. We only charge a 1% deployment fee on dollars. That's it. And that's only collected twice a year biannually. And moreover, the GP profits that we negotiate up front, given our scale, funnels directly into everybody. So you profit and you benefit equitably across the board. We don't have to do that. That might change somewhere in the future. hopefully somebody's listening today, or we'll get in front of somebody that commands more of that profit share, given the scale they're bringing to me. That's the goal. But we have a lot of different creative ways to kind of slice that pie to make sure that everybody's taken care of, and that equity promoter, that profit share is commensurate with the size commitment that you're bringing to us. Um,
Totally makes sense.
yeah.
What we talked a little bit prior about the ability to assume some good debt. Is that just circumstantial, or is that something that you see out there that is often the case with some of the deals you're looking at?
Uh, it's circumstantial. And if you think about it, the reason being is because assumptions are purely predicated on where rates were at the time they were originated or put in place, right? So we were in the trough, so to speak, for the treasuries. 9 out of 10 loans in our business are benchmark off long dated treasuries, 5, 7, and 10-year fixed rate instruments. And so 5-year instruments, rewind, 3 years ago, rates weren't 3%. They still were starting to climb. 7-year instruments that were put in place, 3 or 4 years ago, a bit of a better rate, but really where you're getting the juice and you have a two handle or a low three handle on that
Nice.
loan assumption
Yeah.
is from when 10-year mortgages were originated 4 to 6 years ago. There's good and bad there. One, there's only so much of that product.
Right.
So we've been in a window. We assumed 4 loans in the last year, all inside 3.3%. And two of them were 2.7 to 2.9. That window is going to be closing in the next 12 months because those
At
individual
the tail end.
mortgages
Yeah.
are just maturing and they're
Yeah.
seasoning and they're getting close to disposition or maturity. So when you start, that's one issue. The second issue is that with that is you start talking about leverage deficiency. So when you assume a loan, some products allow for supplemental mortgages or layering in a B note or a preferred equity slug or a mezz loan, which obviously, given my background, very familiar with all of those concepts. I don't love them because they come at a cost. However, it's a way to climb the capital stack and you get more leverage. So if you're buying a property at X and your loan assumption is Y, generally that Y is 50 to 60% levered because value's gone up. In order that's a larger burden on the capital raise, and generally it diminishes your levered IRR returns. So back to the circumstantial period of time where loan assumptions, in my opinion, will be extremely valuable for the next 6 to 12 months. But again, it takes the right operator to go in and navigate that loan assumption process. You got to qualify for it. It's not easy because these lenders want to enhance their credit quality of their borrowers, not diminish it.
Yeah.
They're requiring more sponsor equity out of pocket in deals now, right? So
So you
the
have to raise
credit
more equity. Yeah.
so you have to raise more equity. You have to come out of pocket with more personally as a borrower.
Yeah.
So there's a confluence of events that are occurring really in 2026 where that loan assumption game will remain intact for those guys that have access. We're seeing a few of them right now, but that'll slowly start to subside because mortgages quickly ticked up in the last 3 to 4 years. And you can get better rates today than you could then. And you can run some analysis on prepay penalties, yield maintenance penalties, and it quickly becomes more attractive to put new leverage in place and pay that debt off.
Yeah. Is the It's not fair to generalize this, but I'll ask it anyway. Fannie Mae, Freddie Mac, somebody else's balance sheet lending. Are people active on the debt side? I know it's somewhat of a commodity, but depending on what the terms are or how much debt equity you have, is there plenty of money out there?
Fannie and Freddie collectively closed $130 billion worth of debt placement last year. So they are each annually given a mandate, a ceiling, a cap, if you will. It's about 70, 75 billion per agency. That doesn't include HUD, which is a separate department. Um, but yeah, FHFA needs to be at the forefront from a liquidity perspective, providing debt into our industry, or the industry doesn't work. You can't
Right.
rely on banks, debt funds, private lenders, life cos, etc.,
Yeah.
to front load that that financing machine. So that's not going anywhere, right? And the agencies have a very creative toolbox where they can navigate in and around those caps. There's situations called mission-driven business, affordable rather, whether it's a HAP contract on the property or because your rents are below a certain median income for the marketplace. There's ways that they can circumvent that cap by not only doing a loan that is uncapped entirely, but part of a loan, right? So, for instance, if you're inside certain thresholds, 80% AMI, 60% AMI, you get certain discounts on pricing, on interest rates, which is another attractive variable there. But some of that loan or all of that loan might not count towards that cap. So that 75 billion that I mentioned is likely much, much higher
Yeah.
because they've closed a lot of non-cap business.
Interesting.
And so that's never going to go away. What we are doing on most acquisitions, assuming it can support it, it's occupied, it's stable, it's cash flowing. We can talk about our two barbell approach in a second on how we invest, what types of deals. But we're doing 5-year fixed rate Fannie Freddie debt on pretty much every new acquisition right now. We're getting rates that in the 4.75 to 4.85 range with some interest only. And then that goes back to, how our funds are aligned from a timing standpoint. We want to get in and out of those things. And if you have a 5-year debt vehicle in place, you can exit at no prepay 6 months prior to that maturity. So in year 4.5, we'll be ready to go and get
Nice.
out of those deals. Yeah.
Yeah.
But yeah, they're not going anywhere. They're,
Yeah.
they're the beast. They're the behemoth. They're talking about privatization of them. But there's a lot of fees and there's a lot of servicing power, asset management that goes into the 20 seller servicers that Fannie and Freddie tab annually to deliver that product for them. I used to be an originator of that product at my former employer, so I know exactly how it works. And they're not going anywhere.
It's fascinating. Just as a sidebar, I interviewed on the podcast somebody who's very smart and retired from as a senior executive, leading a couple of the teams and then overseeing many of them at, I think it was Fannie Mae or Freddie Mac, can't remember. But it was interesting to hear a story about how they were incented to deploy capital. Like the teams want to get that stuff off their balance sheet. And so they have rules, but they, do interesting things to get around the rules so they can get the money out the door, right?
Yeah, they do. And it's different for everybody. Some seller servicers service their own debt, so the agencies don't have to.
Right.
Some don't, in which case they have to sell it off and they make VIG and spread on that sale. There's a lot of securitization going on. There's a lot of REMICs. There's a lot of CLOs that take place. However, I'm not an expert in the securitization markets
Yeah.
by any means, but I have a general understanding. Everybody's got their hand in the pocket,
Yeah.
and you can't just turn the spigot off because that's going to create a lot of problems,
Yeah.
both financially but politically as
Yeah.
well. There's a lot
Totally.
of turnover at the top of these enterprises,
Yeah.
and some of them are appointments, some of them are internal hires, but they're directly incentivized to put dollars out the door, and these are all non-recourse dollars.
Yeah.
So if you think about that,
Yeah.
at any point, and it's happened in the past, borrowers can walk away, throw the keys at the lender
Yeah.
and have no recourse to
Yeah.
them, personally guaranteed. They sign bad boy carve outs, they sign loan guarantees, but unless you trip one of those, you're not getting any
You're not
any
obligated
hit
to, yeah.
backlash.
Yeah.
It's a bad boy, so bad boy acts,
Yeah.
fraud,
It's essentially a government guarantee.
yeah. Mhm. Yep.
So let's talk about the structure, the pref, the catch up, how it works
Sure.
in this fund.
So it's our buckets of capital come in three different ways. Okay. We offer an 8% pref that starts to accrue day one, dollars go out the door. Remember, we draw down over time. So that 8% doesn't accrue on your total commitment up front.
It's whatever you use. Yeah.
It's whatever we use, whatever we call, whatever we deploy. That's that is unlikely to be supported entirely by the property level. The reason why that is the case is because we buy a lot of properties that have a value add component that were distressed in some form when we took them over. And so it takes those assets a little bit of time, generally 3 to 9 months roughly to stabilize, in some cases more, which brings me to my second bucket of returns. A lot of these value add deals that we're doing, which is probably half of our pipeline, we buy them with local bank debt or a short-term, variable rate type balance sheet product, which does two things. One, it allows us to get out in a shorter time period, but also it captures the opportunity to do a refinance and return a bunch of capital to us and our investors.
Yeah.
And that is mid-hold period. That comes generally, we're going to have three of them this year. One was closed in Q4 of 24, two closed last summer. So it took the first property a year and a half to get the refi recap. It'll take the second two pack about a year, 12 months. Generally, the return of capital in those individual deals can be expected to be 30 to roughly 70% of your commitment in those individual deals.
Yeah.
Those come right back to you. It's obviously a non-taxable event. It's a non-trade event. That's
Just
like a
return of capital. Yeah.
return of capital, return of principal investment in that
Yeah.
deal. That's kind of bucket two. Bucket three is the exit, right? So every deal, as I've mentioned in the first few minutes of this chat, they stand alone. They're circumstantial, deal by deal run. We can expect to achieve a high net, high 18, I'd say, to call it a low 20s, 21, 22 IRR for every deal that we invest in. Some deal that we hold for a longer period might be a, mid-teens, 15, 16. Other deals might be a high 20s where we came in and had a bunch of cash flow and were able to execute the value add and get out in a condensed time period. That's the rough return profile. And we look to multiply equity again in that 3 to 5 year period. So each individual deal will 2x on average at the deal level. The reason how we can accelerate that is the GP profit share that I've talked about.
Right.
So those are deal level returns. Seaport level returns are accelerated because of that profit kicker that we introduce once the properties exit
It's
to
just
everybody.
participating in the GP, which you otherwise wouldn't do if you were just an LP.
Right. And so beyond that, I'd say ancillary benefits are pass-throughs, are cost segregations, depreciations that we implement in the first 12 to 24 months, generally of each asset that flows directly to everybody.
Everybody gets that on the cake.
Everybody gets that. And, we distribute quarterly, right? So not all of your portfolio, your deployment might be cash flowing up front. However, some of it will be
Yeah.
because the two barbell approach I mentioned, you got the value add deals, which takes some time to season. But we also buy day one yield producers that are core plus new construction that are stabilized. We did three in the fourth quarter last year. Each one of them produced 7% this quarter in Q4.
Yeah.
So you have that balance on the barbell of yield, of value add that catches up with the refi, capital event in years 2, 3. And then obviously they're all on track for that 5 year rough
Yeah, and
exit.
all trued up at the end.
Mhm.
What's since we have a question, if you don't mind taking it real quick, is it uh, complicated or too complicated to take in to the fund 1031 funds because you can't do a like kind exchange exactly, or can you accommodate that?
We can't accommodate it in the funds. However, I probably I probably helped three or four guys this year. And again, it's my deal flow, the consistency that I can offer. Um, I've introduced 1031 capital directly to GPs on three different instances this year, and they were able to capitalize on that
Make it
deal flow.
work. Yeah.
Seaport wasn't even involved, right? And
Yeah.
again, I'm happy to help.
Yeah.
Clearly, I want to incentivize folks to invest with us.
Yeah.
But our network is expansive, and I'm fully, aware that this is a long-term game, and some people might have an exit this year, but a liquidity event next year where they'll be able to participate in what we offer. So I'm happy to build that creed over time, but it's not something the funds are able to do because we can plug them into a deal we're investing in, but it would be kind of like a bolt-on strategy. You would be investing directly into the deal level. You got to get underwritten as a tick, go through
Yeah.
a QI.
The
There's
whole
all
thing.
sorts of minutia there,
Yeah.
but the funds, we're not set up to accommodate that type of single occurrence capital writer.
Yeah. So, Steve, I see you're still there. I'm not sure you heard that, but we'll be on the recording. Thanks for the question. So, what's what's the target raise for this fund?
So we're targeting about 20 million. We're not going to get all of it, unfortunately. We do have probably about 75-25% balance, 75 new LPs in the fund, 25 repeat. Those repeat investors have been in all three prior funds, one, two, and three. However, the focus now is new opportunity and new folks to come in, right? So
Well,
we're
plus the
keeping
current LPs can only write so much of a check, right? So, right.
generally speaking, folks come in and tease us, right? And see how we do. We have a bit of a track record now where people are starting to see the benefits of what we offer. There's obviously been some catch up on returns and cash flow. We now have several quarters where, first, the fund one has been fully deployed and they've been producing. And the same goes with fund two, and fund three is getting its first distribution out. That just started deploying in the fourth quarter of last year. So that's immediate first quarter post closing where we made great investments. And about 50% of their commitments out the door into these three deals that are now producing 6-7%
Nice.
yield.
Yeah.
So good track record, good velocity in that regard. Listen, I think going forward, we're constantly talking to folks, LPs, developing relationships with family offices and institutions. We're not going anywhere. We want to actively be raising funds, I'd say 2 to 3 a year. And I'm going to let the marketplace tell me when we should put a new fund out. I'm not going to aggregate 20 individuals or platforms or levels of interest and have them wait 6 months for another vehicle.
Yeah.
If those conversations materialize in the next 30, 60, 90 days, boom, we'll put one
Yeah.
out May 1st.
Yeah.
And so that's a product of our confidence, knowing we can deploy their dollars quickly because of our deal flow. However, I want people engaged and I want them to come into our ecosystem. We're up to about 600 people in our distribution list in our CRM. They get weekly newsletters, they get deal updates. Everybody in our network sees our offerings the day we make a commitment 60 days prior to a close. It gives people, existing investors, the time to see where their capital is going. But furthermore, it gives people within the ecosystem an opportunity to come in and invest as a one-off, which
Yeah.
we also take too.
Yeah.
And so you can develop those conversations and that rapport and those relationships over that period of time early on, knowing that it takes some time to fully vet those and get people confident and comfortable with what we're doing. So that same idea and logic applies to our JV co-GP strategy. Those are generally being handled or negotiated or worked through with single source capital providers. These are families, these are quasi-institution networks that can commit 7-8 figures, and they're getting their own bespoke strategy, which is a certain profile in a certain market. Some are agnostic, some are a bit more tailored, but that's an ongoing product that we offer. That doesn't stop. So just because we don't have a fund actively being raised for, we are actively in conversations with several single source capital providers to structure their vehicle in a bespoke capacity and deploy their funds in the same way that we're doing our retail funds over here. So the conversation never stops.
So I'm not asking you to give tax advice, but in that bespoke single source check writer, they write the check, the process goes through 3 and 4 years later, they've got all their money back plus their return. Can you just roll it into another one without a
You,
taxable event, aside from all the goodies that come along of
it's
owning real estate?
it's going to be a challenge simply because of how we invest the capital across deals, right? And so there might be a scenario where if somebody commits 5 million bucks, 10 million bucks, and we deploy that in a 4 or 5 property portfolio, one or two of those deals might be with the same operator. They might sell at different times, but we might be sizable enough participating equity in that deal where we can say, hey, we don't want to pay gains here.
Yeah,
Let's identify a new asset to roll this into, but
got
on a
it.
standalone basis.
Yeah,
So it's not going to be the entire commitment. You might incur cap gains tax in
on part
40
of
or
it.
40 or
Yeah,
60% of it,
yeah,
but there is the opportunity with several of our GP operator partners that I trust and am loyal to, where we would put it right back on them and say,
Yep.
hey, we have 6 months to identify a new like kind asset. We want to roll this over. We want to preserve our cap gains tax. We're on board with it, and we're
Nice
50%
problem to have.
and we're 50% of the equity.
Yeah.
So we're going to kind of tell you a little bit what to do.
Yeah. Yeah.
We're going to be, come in and throw our weight around in that capacity. But again, that's a conversation and communication on behalf of myself and our investor, right?
Yeah.
And so we want to keep them happy. We want people to return. This is a compounding event and it's repeatable. And so to the extent that's a term within somebody's wish list, so be it. Let's make it happen.
Yeah. One of the things that struck me when we talked before and also now, uh, but maybe I can articulate it so the audience can hear the way I digested it was not only do you have geographic distribution, so a diversification there, you've got a diversification within the GPs that so you really got multiple diversification going on here. And then layer on top of that, that each one of those GPs are investing in places that they know really well. So it's not like, okay, we're going to find everything in some geographic area and hope that the management of it works. Like you've got two really important things covered there.
We're hedging risk. That's
Yeah,
it, bottom line.
yeah,
Spreading it out, I guess, might be a better term.
yeah,
But when you do that, not every deal is going to be a home run. Not every deal is going to work out on time, on plan, on execution. And so when you spread it out a little bit, you're getting the best of all buckets.
yeah,
And so listen, I can't predict the future for some of our operators.
yeah,
I can only do as much as I can do today
yeah,
with the information that I have, their track record, their experience, their cycles. Mind you, I am very intimate with all of the markets that we're investing in. I've either personally been there before or I've lent hundreds of millions of dollars from my lending career into
yeah,
these areas. I know how they work. I understand the migration trends. I understand employment growth, wage growth, and we have data upon data that we can pull from to pull comps. We talk to appraisers all the time. We know how your asset should be operating before you even get your butt in the seat to operate it. And so we really have a wealth of knowledge and understanding to try to mitigate that risk. And I think one of the best ways to do it is to spread it out a little bit. We don't want to invest all of our capital into one deal because something could go wrong and you're out. We don't want to
yeah,
invest all of our capital into one operator or one market because you don't know what you don't know. And
yeah,
so we're not here to predict the future. We're here to mitigate risk and spread that out. And in my opinion, it's a unique offering set because I haven't run into a platform that has the access that we have with the diverse bench of GPs that we do and investing alongside them, we become very valuable.
yeah,
And
yeah.
so
I think
we
so.
now we now become one of the first calls that they make when they have a new offering, asking us what we think about it. And we can commit to deals early and often and negotiate preferred returns. And everybody benefits in
Yeah,
that regard.
makes sense. What's the also you've executed and performed. What's the performance of the first fund? Can you articulate that?
Sure. So we just put out Q4. Q4 really was when things started to ramp up. Fund One initially started deploying in October of 24. I believe it was fully deployed by July of last year. Some value add in the mix there. We had three properties, seven in total. One was a three pack, so really 10 assets in total, but there were seven transactions. Two of those transactions were pure value add. One was a cash purchase because we had to. We bought it from a bank. And then another two pack was a local bank situation that I've mentioned. So those aren't cash flow. We have a pref piece coming in on the all cash purchase in Wilmington, North Carolina, but the others haven't been distributing at all. However, the balance of that entire portfolio, which is about 80% of everybody's commitment, is producing between 5 and 7.5% yield as of the
Nice.
fourth quarter. And
Yeah,
that five is ramping up. And those sevens are stabilizing.
yeah,
So we expect two of those sevens to get to 8 to 10 by Q2 or 3 of this year. with those capital events through the refis that I mentioned on those other assets that were value add in nature. So the goal with that portfolio is by the third quarter this year to have it in a position to cover that 8% pref across the board for everybody. And that's a rough expectation for us. Fund two will be fully deployed as of Monday, this upcoming Monday. We're closing our last deal in Murfreesboro, Tennessee on that fund. That deal has been distributing since that started deploying in April of 25. That's been distributing again. Part of those deals have been distributing first quarter post close. And so our goal is to mix and match. We're not going to do a fund that is pure value add. We're not going to do a fund that is pure core plus,
Right.
because when you do core plus, you generally can leave something on the table. The upside is not capped, but it's not as attractive long term, mid long term. And so that's the rough target on return profile.
Yep.
Get everything stabilized in a 12 to 18 month time period, have some liquidity events baked in there. And once stabilized, we should be putting out 6 to 9% yield across each asset.
Yep. When, if you had your way, closing end of March on this fund, the new fund?
If I had my way, I'd close it when we hit our target, but that's not, I think, in the cards for us. We want to, and listen, the only reason that's the case is because we've been sitting on commitments since the fourth quarter last year. People made commitments to us, and I've extended it out because I had this deal that got pushed. No, I think we're ready to go with what we have, and
Right.
I want to get those folks onboarded, activated into our system, start to feel it out, because I know with every opportunity begets more, and every individual has their own network. And once they start seeing compounding effects of what we're offering to them as an alternative in our space, people speak, and that is the power of the network that we're building. It's not just the individuals that are on it, it's the reach that we have because of it. And the sooner we get people moving and showing results and getting them feedback, the quicker that can compound.
It's
I'd
the network
say
effect. Yeah.
it's a network effect. I mean, as
Yeah.
I've mentioned, we're at 80, 85 individuals. I want to double that this year. Maybe not quite, but there's something proprietary about building a retail network, building family office relationships that people can't strip from you. And we focus, I would say 75% of our efforts go towards fundraising, 25 are deal flow. 20 is deal flow, maybe 5 is infrastructure
Yeah.
optimizing, the database, the user interface experience, etc. However, it's focused on capital right now because the more capital we can raise, the more outsized our economics become and the more profit we can generate.
So if somebody wanted to start the process of stepping up and, you want to close, first of all, for the audience, get started if you're interested. If there's anybody else that might be interested in this, feel free to bring them over and talk to Ryan. But they should probably get the ball rolling sooner than later,
Sooner,
right?
sooner than later,
Yeah.
things can happen very fast. We are all digital now. There's no wet signatures or notaries that are required. Everything is done on the portal.
Isn't
So
that
we
great?
have a built out portal that we've optimized over time through our fund administration platform that handles database management, books, etc. So I would advise just drop us an email. We can have a quick call. We can get you on the portal so you can start, accessing closed deals, closed funds, but also current activity, which, as I've mentioned, we put out 60 plus days prior to closing. And so you can see the track record and the experience that we have, what's upcoming. And then from that point, it's quick DocuSign through the subflow that we have put out there. I think it's 3 or 4 or 5 clicks, couple questions. Everybody's got to be accredited. We do ask for simple validation or verification of that. Is 5 or 6 questionnaire type breakdown.
Standard stuff, yeah.
Um, Standard stuff. And then from that point forward, the banks are interconnected from ours to yours, and we'll start calling capital. And the reason there's urgency, we're looking to close our next deal March 6th at this point, which is the first Friday in March. And so I like to get capital calls out about 10 days prior to a close They're generally due 3 to 4 days prior to that close. We aggregate everybody's commitment, including our own, and we fund escrow directly about 48, 72 hours prior to closing the transaction.
Nice.
And then it's a rinse and repeat going forward. So I would expect for Fund 4 investors, we're actively looking at new deals right now. We're targeting kind of some late April, early May closings. So that'll be capital call number 2 for Fund 4 investors. We do often co-invest funds, which doesn't apply to this audience because they're unclosed funds, but we're constantly drawing down prior vehicles to co-invest for scale in active current commitments.
Yep, it totally makes sense. Well, I really appreciate you doing this again, and I will make sure everybody gets away. It's easy to get a hold of you, but we'll make sure everybody gets a note from us about that, and then put them in touch. Ryan, amazing, really good stuff.
Thank you very much. I've appreciated our series. It's been
Yeah, it's been a lot of
informative,
fun.
helpful, and
Yeah.
hopefully it reaches an audience that didn't know about us before. But we implore people to educate themselves on what we're doing and have conversations with us. And in our opinion, it's pretty unique place to build out and optimize in our marketplace right
Yeah,
now.
it's a good story, and like I
Mhm.
said, all the goodies that come along and pass right through are valuable. So
Love
I
it.
appreciate
Well,
that.
thank you very much.
Yeah.
Appreciate everybody
You
joining,
bet.
and
Thank you
we'll
for
we'll
everybody
talk
for being
soon.
here. Okay, till next time.
Cheers.
Thanks,
Be
Ryan.
well.
Bye.
Bye-bye.